Good evening, everyone, and thank you very much for joining us. This is part of a series of education webcasts we're going to be running over the next couple of weeks. It coincides with the ASX options trading game. For those of you that are playing the game, you may notice the screen in front of you or on my screen at the moment looks very similar to the options trading game. It actually uses the same technology as our platform. So it uses the same technology. So those of you that trade with our platform trade using the same tech base. This is me a few years ago. Actually, we had people in taking photos of us today. Ivan, we didn't get a shot of you. Ivan doesn't look like that at all anymore either. Well, my background is I've traded options. It's got to be 2 decades now. Personally, as a professional trader, I've run one of the busiest options desks in Australia. For about a decade prior to starting Reach Markets. Ivan built the technology for the options game, so he was there as the technology provider, and we I guess we have kindred spirits when it comes to many things around the financial markets, trading, the use of technology, and ultimately what we see is a way of improving the experience that someone has as a trader and giving them a chance to be successful. That's a little bit about ourselves. Ivan, whose bio is there, is started trading as a young man and was a full-time trader by the time he was 19 years old. Incredibly successful as a young trader. The numbers are outstanding. He doesn't necessarily like me talking about them too much when we run these sessions, but he's definitely a very well accomplished trader on his own account as a very young person, and made a lot of money out of that, and then as a professional trader, and subsequently went on observing problems with the risk management systems and the information that traders received in Australia, and has built his business around that, and that has been a wonderful opportunity for me to collaborate. So when we look at what's going on and what makes someone successful as a trader, there is a whole bunch of stuff that goes into that, and we I guess through Reach challenge the status quo. In the traditional traders, you would trade online at discount rates, but the technology is old. You don't get a lot of support, and then on the flip side of that, you might have a full service broker. They're quite expensive, but you don't get any technology with it. The way we look at it is you should be able to access support as you need it, be that you want the best technology, you want people that are focused on the technology, your experience and your ability to use it, people that can educate you and support you to use it and be better at what you do. But the ability to get trade ideas, get things tested, and the like, and the ability to trade at the lowest prices possible. And these were things that were important to us, because a lot of the times when you look at someone, you look at their trading statements and you go, how did you trade over the last 12 months, 3 years, whatever? You subtract their brokerage, you take away bro, and they're like, oh, you did okay. You add bro back in, and all of a sudden they're not doing so great. And so being able to trade at discount prices really frees you up to do whatever strategy you want, whenever you want to do it, without having to risk huge amounts of money in every instance. And that was a really important part of what we do. So anyway, so just to run through, I think I've probably given a very detailed introduction. So let's get on with it. So tonight we're going to go through how to pick directions. We'll talk a little bit about trading. Any advice contained in tonight's presentation is general only. It doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it's appropriate for you. And I mentioned a little bit about what we believe in, giving you the best tech, giving you methods to trade, giving you education support, but if needed, give you the full service guide that can hold your hand and help you navigate through. We allow you to trade combination orders. You can do whatever trade you want. You can do it online. But when I say whatever you like, we do have restrictions. There's certain high risk positions we won't accept. But you can trade. You've got access to all the information, payoff diagrams, the ability to forecast what an options will be worth in the future. We scan the market for you every day and come up with trade ideas. We've built all the tools and all the information you need to be able to manage your open positions, manage your risk, understand your positions. There's nothing like this in Australia. It's without question the most advanced technology. And then at the same time, our job's not just to give you the tech, it's to support you to use it and keep building it, listening to your ideas. And, we do a lot of development work. There have been a lot of changes to the platform pretty much every month since we started. The business as such has been growing very, very quickly. It's been growing about 10% month on month for the last 6 months. And I think a lot of people now who have been trading options in the past are kind of starting to understand the power of the technology that they can get if they come across to work with us. And we're very, like, there are other things that Ivan and I do in our businesses, but when it comes to trading, we only do one thing. We trade options. And everything that we throw and put all our energy in around trading is something we both personally do and both personally very, very passionate about, is about improving trading and improving the experience. And a lot of the times it might just be stuff like I've got Ivan building stuff because I will benefit from it and I'll be able to use that, and it's a big part of what we do. Anyway, I know that everyone didn't come here tonight to hear us talk about ourselves, so apologies for the elongated introduction. So we're going to talk about picking direction.
Always nice to hear what you think of me.
I'm sorry, Ivan.
It is always nice to hear what you think of me, though. That's good.
Yeah. Now, what we're talking about tonight is, as a trader, how do we pick direction? Now, there are different ways of doing it. There's not one way of doing it that is exactly the right way. There are different ways. People trade using vastly different methods. And, I guess what we believe in as traders, and it's not, and we don't, when I say I believe in this, I'm not saying I believe in it like I believe in this, therefore what you believe in is wrong. No, this is just, I have a belief system about I'm observing information. When I observe that information, it can give me an edge in my decision making that can allow me to go on and make money. And I've got confidence about that belief system. So what do I look at? I look at technical information. I look at price history, and I look at that history and I observe it. And when certain things line themselves up, that gives me confidence that I can predict what will happen next, right? So I've got a method. I'm a sifter. I look at information, and when the different indicators that I like to observe line up, the trade is there for me, I will do the trade, right? I don't consider in my decision making a long-term view of what's happening in the market. So I'm not trying to predict that, the US election is about to happen and that I can trade off the back of that US direction to get in front of what's about to happen in the market. I don't trade that information. I will observe major events, but other than that, I kind of ignore all the noise that's out there. The market was quite high up, a few weeks ago. It sold off probably when coronavirus, people were talking about that. Did it sell off because of coronavirus? I don't know. That's what the news said. I don't know. It sold off because the market was high and it was probably due for a sell-off. It had gone up very, very strongly. When it goes down, people start saying, it's gone down because of the coronavirus. So if I then picked up and said, I think the coronavirus is going to make the market go down, the market then falls, all of a sudden I'm affirming that I think I can pick it based on fundamental information. And I'm not a believer in that as a trader. No good at it. Some people might be good at it. I've not observed those people very often, or maybe ever, that can pick fundamental information and make consistent money out of trading that view, right? So we have the technical information, and in front of you here is a chart of the XJO, and we're looking at it over a period of time. And we like to look at candlesticks. I'll explain candlesticks to you in a moment, but I'm looking at each one of these candlesticks is the trading range of a particular day, all right? And I can look at that over time, and I can observe that, and if I like, I can start drawing lines on a chart where I can start, saying, well, what's the market doing at the moment? It's kind of trending up, and I can look at that different information. And so really what we're doing when we're picking direction is looking at that, and if we can get enough information to give ourselves enough confidence, we will then do the trade. That's how we use technical analysis. Ivan, anything you would add to that?
Right. No. I was just trying to find the mute button. No. All good.
All right. So
I'll let stuff later.
Sorry?
I'll let stuff later.
All right. Now, the reason why we trade options is, well, there are two types of options, and I'm going to move through this in literally 2 minutes. So I know most of you will be across this stuff, but I'll just give a very brief intro. Call options and put options, basically a call option appreciate in value when a share price goes up, a put when it goes down, right? Why do we use options? They give us the ability to leverage into a position, so I can take a relatively small amount of money, and if I can pick the direction, I can make a good amount of money. Maybe instead of risking the amount I would have to use to buy a share, I might be able to risk 5% of that amount, right, or less, right? But still get similar exposure to the share price move, right? So That means I'm risking less money, I can lose less money, and it gives me leverage so I can trade in and out using a smaller amount, maybe benefit from a smaller move or whatever it might be. All right, so calls up, puts down. All right, you can use options in tandem and to improve your, your success, the chances of being successful. You can use options to just simply reflect what your view of the market is. If you think, for example, it's going to finish between this quite wide range, I can use an option strategy to benefit from that. My view is at the moment that we're about to hit a pivot point in the market. Don't know if it's going to go up and down, but I do believe it'll probably go up a bit or down a bit. And as a result, I can trade off that view. So options give us that flexibility where we can just observe the market and then trade our view from there. As far as trading a view goes, and we'll go through picking that, we don't care whether it's going up, whether it's going down, whether it's going sideways, whether we don't know which way it's going, but we believe it's going to go strongly up or down. We don't care as long as we can predict it, right? Which way it goes is irrelevant. As long as we can pick it, we can make money out of it trading options, right? So what is technical analysis? It's the study of price history. It's looking at, if I can look at what happened in the past, observe certain behaviors, then I can predict what I believe will happen in the future. There is, a saying that as an analyst, we are sifters, not alchemists. What does that mean? Well, when you look at a chart, or someone says to me, "Oh, what's your view of BHP?" And I'll look at a chart and go, I could have a view which says it looks like it's going to go up, but unless it meets all my trading rules, I'm not going to put money on it. And therefore, that view is worth nothing. In fact, it's probably better that I just keep it to myself, because someone might read into that to say, hey, there might be an opportunity here. So when we sift through, when everything lines up, we take the trade. But on a day-to-day basis, that doesn't mean we have got a view of the market where we can predict things. In fact, most of the times, most of the things I look at, I've got not enough of a view on it to be able to actually place money and want to trade that view, right? So it's only when everything lines up that we trade it and we follow in on our trade. So, an increasing bullish candlestick here shows that the close of the day, or if the market's currently open, it'll be where it's trading at that point in time. The close is higher than the open, right? And you can see that line there shows you the low and the high. And on the flip, the decreasing bearish candle, the close is lower than the open for the day, right? So it gives us a way of looking and saying, how did the market perform on that particular day, and some context around that. So the candlesticks are a way of, we put them on a chart like we were looking at before. I can look at, and when I look at a period of time, I can observe and identify trends, support and resistance levels, and other information that can be useful. One candle by itself doesn't necessarily mean much to me. Now, when we're talking about this topic tonight, we're talking about looking at one day of activity at a time. Some people will be trading different instruments or just trading in different ways, where they might be looking at weekly candlesticks or monthly or by the minute or by the hour. You can look at all of this stuff in different time frames. We look at it daily. And when we're talking about trading, the other thing that's worth mentioning is when we do trades, generally speaking, we get into a trade, we're not intending on being out of that trade the next day. I mean, it can happen, but our expectation is that we're going to be in the trade, for a decent sort of a move, and we'll be there for at least a week, but maybe even up to a month. Generally not too much longer than that. All right. Support and resistance. Support and resistance is really just telling us where we can see buyers or sellers taking control of the market. Right. So I can see at these different levels, the buyers are taking control, and at other levels, the sellers are taking control. And I can draw a line, and I can see that these sellers are coming in at higher levels, right? But in a consistently sort of trending up. And I can draw a line underneath that, and that's a resistance line. So I'm expecting that in the future, if this pattern continues, that the next level where the sellers come and take control will be higher than the last, right? That doesn't, that'd be my expectation if it behaves in that manner. Now, and the same, we've got an uptrending support line below. Overall, we're channeling up, right? So by drawing some lines around the chart, it's giving me quite a lot of information. Now, not every chart looks like this. So if it doesn't, it's not giving me that information, then I won't be using that information to place a trade. Again, we're sifters. When it all lines up, we trade it. We're not alchemists. If things are all over the place, it doesn't mean we can predict the trade. We just don't look at it. We move on. All right. So support and resistance. Now, you can use, there are different levels of support and resistance and different levels in the market that we'll observe. This is just one way of doing it, and to give you the concept of it. Moving averages. Now, I'll bring this in on one slide. So when you see a shorter term moving average cross over a longer term moving average, that is an indication that the momentum is with the buyers and that the trend of the market is bullish, right? We're expecting the overall momentum of the market to be up. When the shorter term moving average crosses over the moving average on the downside, it's a bearish view. And if we see consolidation of the share price between the moving average, we can expect that that can continue for some time. All right, so these are just some indicators. Predominantly, the way that that we look at it is really just looking at the golden cross and the death cross, which is the bullish and the bearish position. So when the shorter term average moves above the longer term, golden cross, below, death cross, right? And so if you ever hear us talking about that, or someone or an analyst or something talking about that, that's what they mean. And it's probably the most commonly used indicator to kind of have by trend traders to understand what the overall trend of the market and is observed very, very closely by many. ADX is something that we use. It's a great additional filter, and it really just gives us confirmation on how strong a trend is. And we've seen many examples where ADX hasn't been strong enough to want to go after trades for us, and it's protected us about going after a particular trade. So it's really saying, whenever we do our analysis, everything lines up and it's looking bullish or bearish or whatever it might be, the trend is, it's confirmation of that, right? And I won't go too much into this, but this is just an example of some of the things that we look at in the market to arrive at a view or a technical view. What I might do is just jump out of there very quickly and go back to our trading platform and have a look at the market now. And at the moment, this is the XJO. So the longer term moving average has disappeared below my volume, which I could probably just decrease, but it doesn't really matter. Really what it's telling us is, I'm looking at a chart here and just a couple of navigation tips of you that are playing the game. I can look at it, say for example, I'm going to look over a 1 year period, just click on 1 year and it will show me 1 year. I can go 5 year, I can go shorter term, I can go to 1 day or whatever I want to do, right? So now I'm looking at over a period of 1 year, and the moving average crossed over some time ago and it hasn't gone below, and so the market has been trending strongly upwards for some time. And so most of the trades that, from a directional perspective, or really all of the trades that would meet the rules that say Ivan and I trade, would have been bullish positions on the XJO, or they might have been positions where we could make money on a sideways consolidation or on trading on volatility spikes or a pivot point trade, right? So key level for us is a 52-week high, right? That's a really, really important level for us. And we trade off that. When we see that level break, you can see it break here, we get a strong move up, and quite often anyway, when it hits that 52-week high. Or if you don't get a strong move up, what you get is you get a strong move down. So when we're doing a trade, in some instances, we're trying to pick direction. Sometimes when we're setting up our trades, when we're trading options, is we'll trade believing that we think we can pick the direction, but we're ready to switch it to go the other way. Tomorrow we're going to be running a trade group and talking about the trades that we see in the market at that point in time. Depending on what the market does, I'll probably be entering into a trade on that session, which will be a trade where I don't actually pick the direction of it being bullish or bearish. I'll be picking the direction that I believe it's going to go up or down, right? Enough for me to make money, but also that I believe that volatility will increase over the next period of time. So I don't have to pick the direction. I'll be saying that well, it'll depend on what happens around the world overnight. But as long as volatility is where it was today, maybe a little bit lower, and we're around this pivot point, I'll be looking at doing a trade. Because when you get to a pivot point, it's either going to break the pivot point and go up eventually, or it's going to come off. I don't believe it will consolidate for too long up at that pivot point, maybe a couple of days, and then we'll get a move. So the point I'm trying to make out of that is, so a lot of people see trading technical analysis and picking direction through the lens of, I'm picking direction and I believe something's going to go up and I'm going to get in on that and I'll trade it and make money if it goes up. For us, what I would say to that is, if you're a tradesperson and the only tool you've got is a hammer, everything starts to look like a nail, right? If the only strategy you've got is making money when the market's going up, what type of trades are you going to find? You're going to find bullish trades. Whereas if you can observe the market and understand how to pick direction, if it's going, the most likely thing it's going to go up, the most likely thing it's going to consolidate, the most likely thing it's going to go down, the most likely thing if volatility is going to increase, then you simply apply a strategy trading options that's going to give you the best chance of making money out of that view. So that kind of leads us back to a part that I'd like Ivan to talk to, because it's a tool that he's built that is of massive benefit to us as traders. It gives us a significant edge, and we'll probably be talking a bit about this tomorrow in the live trade group. So this is the leading question, Ivan, that I've got to now work out how to hand you control so I don't have to worry about it anymore. Oh dear. All right. But while I'm doing all of that, what's the best technical indicator that can tell us if traders are complacent or if they're fearful?
Implied volatility. Thus, we've even called the platform that name. So while you're figuring out how to struggle and navigate through technology, because this is always quite hilarious how hard it is, we usually do these things together in the same room, but because we've been doing a lot of these, our wives are a little bit unhappy with us. Anyway, so I'm going to be talking about implied volatility. While you're trying to figure it out, do you want to maybe go to the next slide?
Hang on. Do you want to try taking the mouse now? See if you've got control.
Oh yeah, I think I do. Yeah, all right, perfect. So implied volatility. Implied volatility isn't something that I designed per se, but what we've done is we've been building technology for options traders now for a bit over 5 years, specifically in trade floor, and we come from an experience of building risk management systems for derivatives traders as well. And one thing that always struck me is that in the rest of the world, options traders rely on implied volatility to make decisions, because when you're trading options, you're ultimately trading uncertainty. Right? So based on how uncertain a particular situation in the near-term future of a stock is, the premium of the option will either go up or down. And that is directly driven by implied volatility. So before we even talk about what implied volatility is and why it's so important, we're going to go through a few of the pros and cons. So it's a leading indicator, and it's based on physically what traders are thinking the uncertainty of the near term is. It's based on the real sentiment of traders. So it's looking at the near-term future or the prediction of a near-term future from professional traders. We've done a lot of testing on this stuff, and it's got a very good track record of being accurate in the short term in the market and longer term as well, sort of no more than a year out. We've turned it into a ranking indicator to make it a lot faster to go on and filter through the 75 different stocks and asset classes that do have options over them. It's very reliable over the ASX S&P 200, so the XJO, so you get a pretty good clear view of what the index is pricing in over the near term. So it's something that even people who don't trade options should consider using or looking at, because it's an extremely valuable resource to go on and get you to time your entries better, even if you're sort of a long-term fundamental trader, because everything ends up in the long term. It's not available for stocks outside of the top 70. In fact, it's most reliable over sort of the top 20 to 50 stocks. Most trading platforms don't have it, aside sort of from our platform, which is what you get in the game, and also ultimately a much more advanced version of that, which is impliedvolatility.com.au. So implied volatility comes from the market-driven price of exchange-listed options, and sophisticated traders ultimately use options to protect their portfolios. So typically big funds will go on and utilize options globally, exchange-listed options that is, to protect their portfolios in the event of downturn. So let's say, for example, they're cautious over the next 6 months. They use that as a form of insurance. They use it to go on and get extra returns out of the market. So there's sort of a handful of reasons why it's such an important risk transfer mechanism. On the flip side, wherever there's sort of big institutional traders, there's also the opportunity for slightly shorter term traders. So sophisticated investors and traders will use options to gain an edge over the rest of the market and optimize their returns. Now, where implied volatility comes from, I guess, as a very, well, a better way of understanding implied volatility is probably going back to mother. I haven't slept long. The father of modern technical analysis, which is Charles Dow. So he created the co-founder of the Dow Jones company, which is obviously the Dow Index that you probably see quoted in the morning news. And also what people don't know about him frequently is that he started the Wall Street Journal. And so he used to have an article, an editorial that he used to publish every week, and it basically explained the market on this scale of greed and fear over time. So what his research has shown over time, and it still stood up true and still stands up true today, is that really we go through these funny emotional traits where humans are just not built to be traders typically, right? You've actually got to change your mindset because when everything's really good, we get really excited about the future and we get really confident about the market continuing to go up, and it sort of sits in that period, and we typically get to the greediest point at the highest point of conviction. So we're so sure that the market's going to continue going up. Like, for example, right now, there's so much optimism in the market, even despite constant negative traits coming through in the market. The market is on the longest bull run ever. It's trading at all-time highs around the world, even now, despite now the sort of the post-virus sell-off. And then what will ultimately happen, and we did see a little bit of a small subset of this about a year ago, when we were so convinced that the market was going to continue returning for us, that suddenly the market collapsed in a very short period of time, and we went quickly from these emotions of conviction to then hope that, oh, no, it's going to come back, and there's disbelief and then apprehension, where we're just so fearful now, but we're still holding on. And then effectively, right at the end, you throw in the towel, and then you surrender, and that tends to be the start of the next bottom of the cycle. So 2007-8 to 2009 was a fantastic example of the sort of the extreme of this, that disdain, caution, confidence, conviction, hope. With implied volatility, and in particular implied volatility or historical volatility, implied volatility comes from the option price, and it's high during periods of fear because we're so worried that the market's going to continue collapsing, that this GFC event's going to come back because the market's down 25% over a couple of months, and then suddenly we go, we're all trying to buy out insurance or take out insurance, and we go to these periods of high prices, which ultimately means implied volatility is high. When we're super convicted or we're super confident about the future going high, when the market literally reeks of greed, implied volatility becomes really low. And we've been going through an extremely long period of super low volatility on the back of cheap money in the market. So if we look at a one-year chart of the implied volatility of CBA in particular, when we took it, so this was sort of Royal Commission days, but you can go and look at any individual stock and you'll see the same patterns emerge. The market tends to make lows when implied volatility is right at the highest, and so if you can see that on the bottom of every single chart, you'll have the implied volatility indicator, and we we take this from option prices, we weigh it up, so it's always sort of roughly around about the 30-day weighted average of where the market is pricing options that are most liquid. And we put this onto a simple indicator for you to use. This is one of the only forward-looking indicators that you can get in the market. And what I mean by that is, typically if you look at anything, it's looking at the past. How did something react based on some past indicator? And so every time it ended up going to this red zone where the volatility was the highest was every time there was a bounce. And sure, sometimes it was a shorter term bounce, but most of the time it was a much longer term bounce. So have a think about how that can go on and impact you even if you are an equity trader. It's a really good way of picking up future movements, or at least being a little bit better at pricing options. We really got to change the slide because we ran a 6-month research project, but it actually turned into over 9 months. But what we did is we worked with our quants and we created a project specifically studying implied volatility and then just directionally neutral strategies. And what directional neutral strategies are is when you physically make money when the underlying price doesn't go anywhere. And what we got out of that is we've proven empirically that using a sample of 55,000 samples of daily data, so all the data we had, we've proven that actually the traders in Australia make a very good prediction about where the market's going to be. And so as we know from sort of the normal bell curve statistics, that anybody who has, who studied stats in the past would see this natural kind of bell curve distribution that we're used to in all random events that occur. And so what we did is we took the actual change in the stock price compared to the next options expiry, as long as that options expiry was sort of 15 days plus, and then we did this over a 3-year period. And what we found is that one implied volatility effectively is one standard deviation. And in sort of traditional statistical rules, you expect that a one standard deviation move has a 68% chance of happening. And this is sort of going back to the earlier slide that Pat had, which is we trade probabilities. We don't trade a binary outcome, which is we're going to buy today with the assumption that the stuff is going to go up. Now, that doesn't mean that it goes and replaces your overall investing mindset. But it is an add-on overlay on top of everything else that you do. So one standard deviation should be roughly at 68% chance of accuracy. The real result was 70.5%. The statistical estimate for a 2 implied volatility move is 95%. We actually got 95.3, and a 3 standard deviation was 99.5. We actually had 99%. So and what that means is if CBA, for example, has an implied volatility of 15%, then there is a 68% chance that it's going to move no more than 15% up or down over the next year. So we pair that back to make that applicable for the short-term period, and that's in the expiries that we go on and trade. So we use specific option strategies to then take advantage of these times when we know we've got a statistical edge. We look at a bunch of different things lining up and variable scales of lining up as well. So for example, when we've got a trade idea come out, what we do is we take into factor a bunch of different things that are occurring in the market, and then we tweak it, and then we'll give it sort of a confidence rating. So you might have 4 out of 5, which will give you, but you might have something missing. So we'll look at things, but it's all driven from ultimately implied volatility and price action to go on and give us those edges. And so on a very basic kind of a trading example, when let's say that the sort of, again, it's CBA, for example, and half of the people in this room wanted to go on and buy the stock and half of us wanted to sell, we typically come together at a price point and we say, okay, well, half the room will go on and transact at the price they've got in the market, call it $70. Everyone, absent anything else, is happy to go on and say, traditionally what will happen is, okay, the people that want to go and buy the stock at 70 will buy from the guys that are happy to sell at 70. And so the market doesn't have any kind of emotional elements. But then when we start adding news and people's emotions get in the way of clouding future decisions, suddenly, let's say there is a Royal Commission kind of event, the sellers might be outpacing the buyers. The buyers might not be comfortable buying at $70 anymore, and they pull their bids. They put it down below 65 or 60 or 55 or whatever. They said, now we reassess the value of the stock. We don't really, it's not like we've suddenly managed to go and calculate the real fundamental value of the stock, but the emotional side of us goes, oh, well, I'm not happy to buy at these prices anymore, if only it went down a little bit. And the sellers panic because suddenly they feel like their wealth is evaporating, so they start pushing it. And so that's where fear and surrender come in, and that's where sort of implied volatility comes in. And so we showed the IV rank, which then shows the actual volatility expense for that asset. So how expensive is it today? And it's effectively a value between 0 and 100. It's unique to our platform and on all the numbers that we've been doing, and there's a real statistical edge to looking at the top performing blue chips in Australia and actually having a good insight on this. If it's 100, it's sort of signaling there's a heightened sense of fear in the underlying asset. That's typically where you go in and sell insurance to people willing to buy it, because typically the market doesn't move that much. And then you go down to 0 when, it's literally trading implied volatility at a 52-week low. And you can sort by this in the implied volatility platform by sorting by IV rank in the stock screener. You click on that, it'll pop up. So that means that, for example, Lendlease in this example has an IV rank of 62, which means it's pushing towards the more expensive end of implied volatility. So there's probably a chance that Lendlease has sold off at this point in time, fear sort of coming in. And when IV rank is high, where the real statistical edge comes in is if you know this, and this is the stuff that we've done, is that there's a lower dispersion. So it's, you move to the next expiry almost halves compared to what you typically get. So the underlying stock has a much lower chance of moving even half a standard deviation. So if it's 15%, then it will move less than 7.5%. The chances of an unexpected event almost halve, so you get more predictability, and it's a lot less fat tail risk, which is sort of the completely unexpected events, because there's already been a move, then everyone panics, and then the market consolidates. And so while everyone else is sort of dumping their stock positions and driving volatility up, or the complete reversal where they're actually driving volatility down by being ever convicted about the future, we actually become sellers of the uncertainty, or traders of the uncertainty itself. And then ultimately that then goes into the overall trading system. So this is where Patrick can speak to this.
Yeah, okay. We're actually going to skip trading systems tonight. Trading systems is going to be the third webcast we're going to run, but I didn't remove the slides. So
that's okay.
Just there. Thanks for that, Ivan. And look, I think we're options traders. We talk about volatility a lot. You may guess based on the name of the platform, volatility, that we kind of think it's important. We also own a URL called volatility.com.au, which I've owned for a while. Ivan built this great tool. Then you can go in there and you can put any stock in there. It will tell you based on volatility, the forecasted trading range for that stock. Really cool little tool. But it's stuff that we talk about, very, very important, and it really can give you a significant edge. At the moment, we're going into a reporting season, and we're in reporting, stocks are reporting, I should say. And when that happens, it's interesting. You see volatility will increase leading into that based on there being this event that's about to occur, and it'll either be good news, bad news, indifferent news, but people will try and predict it going into it. Then they might be disappointed, or they might be, excited about the news, and you can see share prices move around. And it's going to be something that we'll be talking about tomorrow. Some examples of trades, trading just purely the fact that we believe volatility is going to increase, and we can trade that. So, and there's some really good little trading systems around that can give you a significant edge in the market. Someone was asking, can they get the PowerPoints? We don't actually hand the PowerPoints out. This will be a recorded round. If you want to go back and have a look at it, you'll be able to do that at any point in time. We'll send it out with the morning update that you should be getting every morning.
But also on that, we run a whole heap of education, and we talk about different points. So yeah, it's probably a lot more contextual if you keep attending all the stuff that we're doing.
Yeah. So yeah, exactly. But one of the things that we do is if we're looking at, say, picking a breakout move, right? And we'll trade a view that we believe a move's going to happen and it's going to be a significant move. And we've got a set of rules for that. And the rules, I mean, if I go back to a chart, probably the best way of discussing it. Sorry, I'm on home internet, which is competing with 1,000 people watching Netflix and Stan probably. Let's
How
go.
many people do you have living in your house?
Yeah. When we're trading a breakout, there's a set of rules, and I might just go to a scanner. Trading scans, right? So every day we scan the market and we look for certain things happening. We don't worry about watching and checking every stock. We just set our scans to things that we know give us a high degree of confidence. So when we see a stock and it's trading at, first thing we want to see is it's broken its 52-week high. We want to know that the golden cross has occurred, it's trending up, the ADX is above a certain level. All of these things line up to tell us there might be a trade there for us to trade. And then we'll put the trade on. So if you want to get access to all of the trading scans that we do, and you can see here CBA has gone into a lit long today. We'll have a look at that trade in a moment. But you'll see that there are a lot of stocks that are approaching lit long breakout trades. And breakout trades are trades we love. We're usually trading significant movements. When we trade the options trading strategy we use, we're not targeting like 20% return, 30% return in the month. We want to get 100% return or more. So it's one where we go after it. The trades are there. There's usually one or two every week. Sometimes there's more. You can see at the moment CBA has presented itself, and you've got another 6 or 7 or 8 stocks that will be close to and at key levels very, very shortly. For those of you looking at the XGO chart before, you'll see that it's approaching that 52-week high. There's a lot going on. So we'll run a session over the next couple of weeks, which will just show you some of these trading setups and how you can do them. But if you want access to the education behind all of this, or you just want to get access to the trade ideas, type in yes into your chat box, and we'll organise to get you a trial onto the platform so you can get access to it. And I know some of you are going to be playing the game and the like. We can extend your trial beyond the game, so give you a really good opportunity to practice using this and back testing and so forth, so that you can actually test that you can do this yourself. All right. So type in yes if you'd like to get the trade ideas. That'll also give you can also type in yes if you'd like access to all the education. So showing you how we set these trades up. We do a whole bunch of different trades. It'll also give you access to the trade group discussions that we do on an ongoing basis and all the other information that we produce, all of the research projects and everything else that we do regarding this. But it gives you access to the trading platform so you can do all your trading and practice out around there as well. So, yeah. So the
that back
next,
testing, by the way. Oh, just go. That back testing is awesome. In particular, now that for those of you that are busy but want to go on and play around with some concepts, and that want to go on and do that in your own time after the market's closed, you want to get some confidence. That back testing tool is specifically built for people developing trade styles, so you can go on and click through and look at what the market would have done, and so you draw all your technical analysis stuff if that's where you're trading. And you can sort of move forward with that. So it's pretty good. So you can,
yeah.
I love it.
For those of you that are coming in through the game, the platform and the game mirror each other. Have you brought the dashboard into the game as well, Ivan? I haven't logged in.
No, that's not in the game. So yeah, you actually got to go to implied volatility for
that. So just quickly, as by way of a quick tour. When you log into the platform, you'll generally land on a screen that will, sort of show you some information, more broad information, and then you come onto a trading dashboard page, which you can sort of set this up. And for those who use multiple screens, you can lay out whatever information. You might want to look at the chart, market depth, a whole bunch of different things that you can set up around that. So that's the dashboard. You can control that as you wish. For options traders, you'll generally arrive in the strategy builder, right? And so for those of you who are playing the game, very similar. You can go in there and you can practice trade. Anyone that uses our platform, we always have two accounts that you run. One, I've got my Patrick Nelson account, which I trade in, and then I've got another account, which is just stuff where I can test and practice trade, and I can put trades into the market at real market prices, but I'm not risking real money, right? So we give you the ability to do both. And then you've got payoff diagrams. So here I'm looking at a particular strategy. I can see the payoff diagram. I might take that out, a couple of expiries. So I can look at the payoff diagram, and that will show me, what I need for this to do, what I need to occur to make money out of this, right? So in this particular, it's a long straddle on the SJO. I want the market to go up or down. I just need it to go somewhere, and I need it to go somewhere within a period of time. I don't have forever to get my directional move right. We have a thing called a matrix, which you can use as well, which will show you. I might just try and add a couple of columns to this. All right, so I can see, okay, well, the different intervals. So today the share price goes up by 1%. I've made $500. If it goes up by 2%, in 12 days time, it's up 2%. I've made $700. But if it's gone sideways, I've lost $700. So I can understand what I need to happen. I can adjust the price increments, and I can then bring volatility in. So I can say with this particular trade, well, if something major happens and volatility goes up to 50%, which it does, when that would be going from 11% up to say 16%. I don't need the share price to move. You can see it right here. If volatility spikes, just by itself, I'm making some very, very good money, even if the share price goes sideways. So, we built all the tools where you can bring that information into your decision making. So if you'd like to get a trial of this and you can play around and practice and do all those things, just type yes into the chat box. You'll be able to get access to trades that we do, where we scan the market each day for directional trades, sideways trades, and then you'll get our commentary on the different trades that we might be doing that we haven't yet put trading systems around, and you get access to those. For those of you who haven't requested a trial, just type in yes, we'll get that for you. And within this, you might go, oh, look, Patrick, I hear what you're saying. You're telling me that your quants have gone away and spent thousands and thousands of hours testing your hypotheses to give you information that you can then use to have an edge. But, it doesn't necessarily, but I want to test it for myself. And that is, so we built a back tester that allows you to go in, and at any point in time, and if you're playing the game, this is all built into the game, you can go in there and you can actually just go, all right, let's go, if anyone, go back to any point in time, choose whatever stock you want. So if I might go, let's go back on CBA. Let's have a look at, you could go back a couple of years. You could say, I want to go back to January. And then you can go in and actually create, you can look at a chart and you can go into and set up trades, right? And so, well, if I followed your trading plan and I did an iron condor back in Jan when the indicators would have said it's a good time to do it, how would that have worked out? All right, so I can go iron condor, let's say, put that trade together, expiry date, we'll just do that.
The really powerful thing about that, by the way, just going to say, the really powerful thing about that, by the way, so we store prices, the real options prices at that point in time. So, when you're doing this simulation, it's not just theoretical prices that you may or may not be able to actually get in the market. That is physically what the prices were at that point in time.
Yeah.
Given to us by the ASX.
So I've set up a
very real
four-legged iron condor trade in this example here. I can change the valuations. I'm only risking on this particular trade, my maximum profit is $119 for a four-legged trade. You clearly wouldn't do that unless you liked making your stockbroker rich. But you can adjust that, and then as you tick through, it'll show you on the third what would be, how that trade would have gone for you, right? So, it allows you to tick through. So you can do this. We're big believers that regardless of what you do, whatever trading strategy you're using, it's tested and you've got a method for going about it. So these are all just tools in there to help you confirm the way you want to go about your trading. And as Ivan mentioned, it's the only source of the implied volatility data that powers all the options pricing. So we can go back to whatever point in time and say, on this particular day, what was the option worth? And 5 days later, what was it worth? And it doesn't matter what strategy you want to put together, you can go back and you can back test all of that and prove it for yourself. So you can do that if you wanted to test the stuff that we've come up with or your own strategies. A lot of people have belief systems that are based on some pretty flimsy kind of data. And so, someone might tell you, if this lines up and then that happens, it'll break up and you can make money trading that. You might do a course or read a book or something. Go back and test it. Does it line up? Can I make money out of that? And you can use this as a way of back testing and checking all your trades, right? So that's good there as well. But we're the only place that allows you to actually go and put a trade on and place it where you're using multiple legs, right, and do it at the same time. And that allows us to do online trading that previously you had to call up and speak to a full service broker to do. And by making that phone call, you're basically paying away a lot of money. A two-legged trade that you're going to get in and get out of might cost you $100, sometimes a lot more than that on the way in for each leg. So that's $200 to get into a long straddle, $200 to get out, $400. I mean, I've traded 2 long straddles off a $5,000 risk recently, and my profit was about $400 on both. If I'd been trading with the over-the-phone broker, there are some benefits of sometimes doing that, but you have to have a good reason for it. And in one of the instances, there would have been benefit having an online broker because they could have helped me get out of the trade faster. But if I was just watching it myself, why pay that away, right? $400, it meant that I did a trade that was, marginal. It didn't really do what I wanted to do, but I still made $400 out of it, which is a 10% return on my capital. If I'd been trading over the phone, I would have given 100% of that up to a stockbroker, or maybe it made a loss, or maybe that would have then changed the way I was looking at the trade, going, I need to hold on a little bit longer until I have a profit, and those silly sort of decisions you make because of the bro impact that it has. And also the other benefit is it means that you can do strategies where, you can risk smaller amounts of money, but the brokerage isn't eating into it, and that's another really important part. But ultimately, this is all being built for options traders. It's without question the best tech. We're really passionate about it. If it's something that you want to have a go at, have it tested out for yourself, you want to do the education behind it, just type in yes, we'll get you all the details, get you set up for a trial. Tim, who's in Adelaide, I think today and tomorrow, will be back in on Monday, so he's going to be available for any questions that you've got as well. But live chat's still open, and we'll support you by that if you're going through it. But guys, that's tonight's session. We're talking about picking direction, so we've covered a bit of territory. Hope you've learned something new out of that. We'll pick up on the things we talked about tonight and embed them into the trading strategies. So the next session, we're going to be talking about the main strategies that we use and that we see people using to good effect. We'll show you how we set up the trade. So we're going to look at an iron condor, which we've spent thousands of, we've had people just looking at millions of data points to help give us information to set those trades up. So we'll show you how we set those trades up and our rules around that. We'll show you how we pick directional breakout trades, bullish and bearish trades. So we'll show you how to make money when it's up, when it's down, when it's sideways. And we'll also share with you how to set up a strategy called a long straddle, which is a trade where I don't know which direction it's going to go in, but I believe we're at a major pivot point, and I believe it's going to head one way or the other, or I believe there's going to be a volatility event, i.e. reporting or whatever might be going on, and just volatility is going to go up. And I can benefit greatly from volatility going up, as I showed you earlier. So we'll show you those particular strategies in the next session. Then the final session will be all about how you pull that together into a trading plan that's robust. It's going to put you in a position, the best position possible to make money out of the trading that you do. All right. So thank you very much for coming along tonight. We appreciate you being there. On your way out, there is a feedback, a little mini survey. There's only like 2 or 3 questions on there. I'd love it if you could just put some feedback in there on how you found the session. If we can improve, please let us know how. And if you have any assistance, please also let us know how. And thank you for everyone taking the time to be there and come along tonight. If you haven't already typed in yes, please do so, and we'll organise that trial for you and get you using the best tech in Australia. But that will also give you access to our trade ideas and all our education, back testing, and all the other technology, market data, and so forth that comes with that. So thank you very much. Ivan, anything you would add?
No, thank you for having me on your webinar.
That is a pleasure. All right. Well, we'll see you on the next session, and thanks to everyone. Have a wonderful night. Cheers.